If you've seen my videos, you know I'm a fan of the brokerage account or the taxable investment account. I think this is the most underutilized account out there. Now, if you've done some research on taxable and brokerage investing, you know that you can structure that account any way that you want. Today, I want to talk to you about a way to supercharge that and specifically how you can utilize that account to create more efficient Roth conversions or moving more money to Roth in early retirement. The name of the account is the direct indexing or a custom indexing account. I'm going to introduce you to it, who it's for, who should use it, who shouldn't use it, and how this can be fitting into a larger tax planning strategy for you as an early retiree. I'm Forrest Dutton. I'm the owner of Brightworks Financial Planning. I'm a certified financial planner, and I really hope that you enjoy today's video. It's really meant to be just educational. It is not meant to be personal, financial, investment, or tax advice, but I really hope that it helps you get the most out of your early retirement when you think about how this plays into a larger financial plan. Let's start today's video by just discussing what we mean when we say the index. So what I have on the screen here is the returns for the last 100 years for the S&P 500 index. You're probably familiar with it. If your friend says the market's up, the market's down, they're probably talking about the US S&P 500 index. Now, the purpose of this video is not to explain everything about that index, but I do want you to know that simply represents 500 large companies in the United States. So you've also probably heard of an index fund. If you own an index fund, it means that you own this chart. So in the year that the S&P 500 index is up as an aggregate, your return is going to look like this. The green is obviously positive returns and the red is negative. So the reason I'm showing you this visual is because when you think about 500 companies, even though the overall aggregate index may be high, you probably heard this in the news the last 2 to 3 or 4 years, you've heard a lot about the Magnificent Seven. These are the largest companies in the United States that often have outsized returns. Now, here's the reason I'm showing you this. You can really count on two hands, probably, how many times the S&P 500 is pretty flat, right? So there's not many years where it's just barely over zero or barely below zero. Now, the reason custom indexing can be helpful and the way it can actually work for you is, one, you don't have to rely on just getting the return of the index alone. You can then actually own the individual companies that make up that index. Now, in the past, this wasn't possible. There was a couple reasons. One was cost and the two was technology. Now that technology is here, this used to be only ultra high net worth investors and institutional investors. Now this kind of thing is available to all retail investors or those that work with an advisor. Now, I will say this isn't for everybody, but I want you to know how it works. So in a given year, so for example, let's just take the last few years. 2024 for the S&P 500 index was a very, very positive year. You're going to see that with my cursor. That was represented here. Very positive return. 25, very positive return. Now, inevitably, there are companies within that index that were actually down, even though the overall return was up. So when you own a custom index or you create a direct index, you are owning a series of companies in the weight that they make up that index. So the larger companies are going to be a higher percentage of that index and so on and so forth. So what can happen is if you actually own a custom indexing account and you structure your portfolio inside your brokerage account that way, it means that when there are opportunities for individual companies or stocks to go down, you can then actually sell that at a loss, and then you could reinvest in something that is either the same security as long as you wait over 30 days or something that's substantially similar. So in that case, you want to avoid what would be called the wash sale rule, because if you have a wash sale, it means you're not allowed to use those losses. So when you have a custom index, it allows you not only to earn that overall return as close as you can. There's going to be something called tracking error, which means it's not going to be exactly the same as owning an S&P 500 index fund, but if you own those companies in proportion that they are an index, it will closely mirror what those returns are. So you get the upside of the index returns, but you also get an additional upside, which is in years that are losses. If you just owned a regular index fund, you just have to take the loss. You can't do anything with them. And the way that the tax code works is if you have those losses, those are called capital losses. Now, capital losses can be used in two ways. They can either offset your ordinary income. That's if you have no other capital gains that have been realized within your account in that year. They can offset your ordinary income at $3,000 a year. Now, if you're in the 32 or 37% tax bracket, that alone is very beneficial on a yearly basis. Now, the other thing that can be helpful here is when you have a capital loss that is over and above that 3,000, it can be carried forward indefinitely. So what a direct index account can really, really do for you is you can, if you fund it in a very aggressive manner, meaning you start at a high number, you are basically deferring capital gains into the future. It is not a savings on capital gains. At some point, those savings will come due. Those capital gains will come due. And the reason I'm mentioning that is because I want to be very clear what it is and what it isn't. So it is a deferral strategy for capital gains. It can help a high earner in the year that they are contributing if losses pile up in the account. If you fund it aggressively enough, now for an early retiree, this could be someone, say you hit 50, 55. This is a great account if you have an inheritance that's a large amount. If you want to put that in this type of account, again, that's not personal advice, but these work best when they're larger sums and when they're funded regularly. So if you can continue to fund this, there are many articles and things you can look at when you look at capital gains harvesting or losses in these types of accounts. Now, again, I can't tell you exactly what they'll generate. It depends on what this chart looks like. But there have been many articles or back-tested studies that can show on $1 million portfolio, you could easily have a 20% of that amount over a period of years, right? It would probably be over a period of 5 years, maybe 10 years. And then that means you could have a potential carryover of multiple hundreds, thousands of dollars. And I'm going to show you in a second how that fits into your overall tax planning distribution plan or income plan as you're approaching early retirement. Okay, let's start out here and let's talk about what we mean when we say the taxable brokerage account with a custom indexing strategy and how it actually looks, how it actually can be beneficial, how it can be harmful for some people, and let's talk through it. So first, I want to identify the use cases, okay? And then I will come back to why I think it works so well for an early retiree who's trying to have a specific tax planning strategy. So number one, high earners. Okay, so why high earners? Reason being, capital gains brackets are 0 and 15, but they can be upwards of 20 or 23.8. Then you have added state tax depending on where you live. So if you want to defer capital gains, high earners is the number one use case. If you know you're going to be earning less in the future, you're basically being tax efficient, and that's called tax alpha. Number two, those who will have a liquidity event in the future. Okay, so why am I writing that? So you're a business owner, you own a business, you know that your business sale is going to come with a large sizable capital gain. That would be the number two reason to use an account like this. Number three, you know you want to have giving / legacy goals. Now, what do I mean by that? Okay, so giving / legacy. What I'm going to show you in a second is that one downside to this type of account is that there's actually a lowering of the cost basis. So normally we want a high cost basis inside a taxable account. That means, say you have $1 million, $750,000 of that is yours. That means if you liquidated the entire account, that means only $250,000 comes out in the form of capital gains. Now, the opposite is true if you do direct indexing. So every loss that you end up not harvesting, but carrying over, you have to harvest it first for it to carry over. So both are correct. but every loss that compounds in that account just lowers the cost basis. So let's say that you put in 100,000. So say you put in 100,000 and in year one, it was a very volatile year. And let's say you have $10,000 of losses. So then you would look at the cost basis and it would end up being 90. So, right. So even though you put in 100,000, normally that would be your baseline, right? So even if the account is down, that means you would have a loss in the account and it would be coming back up over time, but you have voluntarily taken a loss when it occurred, not knowing if that account's going to go back over it over time. This is the first con I want to address here. This is not a short-term strategy. Now, there are ways to take a taxable brokerage account and utilize it so that it works faster. And you have to apply leverage and you have to do things like long short investing, which isn't bad, but that's not the focus of this video. I just want to talk about basic custom indexing. So maybe I'll do that in a future video. But for giving and legacy, here's why this doesn't matter. Say you harvested the entire account again. This is just for demonstration purposes. And of that 100K, let's say you harvested 90,000, right? So that means the cost basis would be 10,000, right? So if it never grew and you go to take out the 100, well, you have to pay $90,000 in capital gains. But if you know you're going to give this, either you're going to give it to your children during life. So basically you have children. Okay, I'm going to kind of write that on the right. And this is going to be, I'm just going to say at death. Okay, the reason children would matter is because a lot of them might be in the 0% capital gains bracket. If you want to then give them some of those securities while you're alive, if you have a large enough estate, you're just removing that from your estate and they're paying less taxes on it. The option 2 would be at death. This is going to be revalued. So if you give them that 100,000 at death, on day one, their cost basis is 100K, even though it should have been 10. That's called a step up in basis. So that is another use case. And those are really the primary use cases to me for doing a direct indexing account. You're a high earner, you have giving and legacy goals, or you know you have a big capital gain. Now I will add real estate investors in on that as well. So if you know you're going to have large capital gains from real estate properties, this could make sense too. But I'm going to add a last category, and that is going to be tax planning in early retirement. Now, if you've watched some of my videos, I apologize. I think you know that I write like a kindergartner, but hopefully you can look past that and see the value in this. So why am I even mentioning this? So a lot of people, when they enter into early retirement, one of their main goals is they want to do Roth conversions. Okay. So what I'm going to say is one other use case, say that you check maybe one of those boxes, maybe two, but not all of them. This could be another thing that you may want to consider about having this type of account. So this next section of the video, I'm going to actually walk you through how this would work and how this would impact your overall plan. All right, let's discuss direct indexing in practice. So this is, again, I'm going to call this section Roth conversion arbitrage with direct indexing, and you'll see why in a minute. It's because use of a direct indexing account with proper distribution in early retirement can allow you to convert more for less tax than you would without this type of account. That's basically the take-home message of this section. Now I'm going to walk you through what this actually means. So I'm going to start at the top, and I've got two scenarios here. One is called with direct indexing, one is called without direct indexing. And in both scenarios, I have Bob and Sue. They are 60 years old. Bob decided to hang it up. He was the high earner and just didn't like his job. And Sue wanted to continue working for a while. They're both 60. She wants to work till 65. So what you're going to see here is you're going to see a wage number for Sue. That's $30,000. She's going to work $30,000 full-time until 65. She's happy. She loves her job. They have a goal to do some tax planning between age 60 and 65. So what you're going to see here is there's a Roth conversion area, and I'm going to put in some different numbers. Now, the purpose of this video is not to determine how much to do or how to come up with the analytics of is this the right decision for them. I just want you to see the benefits of this account in the way it's being used. So I'm going to put $100,000 in here. And what you're going to see here is a large section on capital gains. And this is where I want to dig into the details with you. Okay. So I'm going to click into this section. And as I do, I want to just go line by line and explain to you what we're looking at. So I'm assuming that this is and I'm going to pop up a window here so you can see this. I'm assuming that there is at least a $1 million brokerage account. And over the course of however long this has been utilized for direct indexing, it's been able to amass 200,000 in carryover losses. Okay. That's important for you to understand as we're looking at this section. So let's take that off. And now look at this. So this first line item here shows those carryover losses at negative 200,000. Now, the other sections that you're seeing require some explanation. So remember, Sue works, she has $30,000 of income. They both have decided that to do some tax planning and to leave room for some Roth conversions, that they want to live on $80,000. So what this 37.5 is, and again, it comes back to my definitions of how custom indexing or direct indexing works, is simply the capital gains that comes from, and I'm going to pop this up again so you can see it. This comes from $50,000 of a distribution from that account. So they actually took out $50,000 into their account. 37.5 is showing you what actually flowed through to their taxes. So this is the long-term capital gain is 37,000. So I'm just going to put an arrow and put 37.5. Okay, so far so good. Those are our living expenses. That's it. Now the next line item might be a bit confusing to you. And since we have such a large carryover loss, we can continue to take out losses from this account, and it's going to be at 0% because of the 0% capital gains bracket. Again, I've discussed this in other videos, so go back to some of my other videos and check those out if you want to learn how that works. But basically what this is allowing you to do is they're 15 older. So the fact that Sue is still working, what I would suggest here is that they would distribute more capital gains in this year simply because they can at 0%. So that 12,009 represents, I'm going to put another number on the screen, 8,600. Okay. That is how much you can put in a Roth IRA. So I'm just going to write Roth in 2026. So what I'd like to suggest they do is they simply fund that together in a backdoor, or actually in this case, since they have a low income year, they can just put that in directly. But basically what they're going to do is 17,200. That's what they're actually going to take out from the brokerage account. And just like I did the arrow before, that leads to $12,900 in capital gains. Because remember, about 75% of what they take out is going to be capital gains. Again, that can be a downside, but we're using it to our advantage. So do you see what I did there? I just added an additional $17,200 in Roth for free, right? We didn't pay it. We didn't pay anything on that. We just utilized our 0% bracket. And in this case, honestly, we just utilized our negative. We haven't even gotten to 0. So that's where the 12.9 came from. Now there's one more that's going to make this even more powerful. And that is Sue is still working. And in 2026, you can defer $24,500 into an employer's 401k. So what I suggest they do is take the 24.5 out of the capital gains and simply defer all of her income into her 401k, and they're actually living on the amount that she defers. So hopefully that makes sense to you, but basically instead of taking her paycheck, they're going to take the money from the brokerage account and live on that money. Meanwhile, deferring $24,500 into Roth 401k. Okay. So what I was able to do here is I was able to add an additional. So if we take the 8,600 times 2, I was able to add an additional 17,200 plus 24,500. And you're going to show that. I'm going to show you that in the screen in a second. So hopefully I haven't lost you. But total, that's an additional 41,700 of a conversion that you paid nothing for. Okay, so I know their bracket isn't high this year, and that's why we want to do this. This is a really, really good tax planning opportunity. So what I want to show you next is how that actually flows through for taxes. So on the left, you're going to see the total tax due. Their taxable income is their total adjusted income is 127. They have a standard deduction of 32.2, which puts them in a taxable income of 94,800. Now that's really important. We don't want to go too much over that, because if we did, then we would start to recognize capital gains above 0%. So what I've done here is I've just allowed them to do essentially what looks on paper to be a traditional $100,000 conversion, but in reality, they actually moved 141,700 to Roth. That's why I'm calling this arbitrage, because not only did you pay the tax amount for that, you actually got the dollars in, which is the whole point in the first place. So what I'm showing you is if you did not have that direct indexing account, you would have to do this the traditional way, which is just to completely convert it all out of the IRA. And in that case, that would cause a larger tax burden. And I want to show you that, quantify that. So that would put our taxable income so much higher. And then that would cause a total tax that is more than double. So this is really, really powerful and important, in my opinion, well worth it, and well worth understanding how you can utilize these strategies. These are the kind of things that I love to do at BrightWorks, helping clients figure out how to get the most out of their accounts, the most out of their goals. So I hope you enjoyed today's video, and I will see you guys on the next video. And by the way, please subscribe, please comment. I want to know if you think this makes sense. I want to know what you're doing, and if you've even thought about this, because I've seen a lot out there on direct indexing, but I think it's being underutilized by this segment of the early retirement population. So please let me know what you think. Please subscribe. That's how more people find this content. That way more people can become educated. And again, let me know what you think, and I will see you guys on the next video.